In 2026, the biggest mistake investors will make isn't buying the wrong stocks or mistiming the market. It's chasing dividends that look incredible on paper but quietly drain their wealth. I'm talking about monthly dividend ETFs that flash an 11% yield but leave you poorer than a 3% fund 5 years later. One high-income ETF actually underperformed its lower-yield competitor by over 140% in just 5 years. That's the dividend trap most investors walk straight into. You're collecting checks, but you're not building wealth. But here's the good news. In this video, I'm breaking down the only 5 monthly dividend ETFs you actually need for 2026. These aren't just income funds. They pass what I call the triple income filter, a system that weeds out yield traps and surfaces only the ETFs that pay you, grow your money, and survive market crashes. One of these ETFs delivered a 19% return since launch, while paying a 14% yield. Sounds impossible, right? Stick around, because I'll show you exactly how it works. Not only that, at the end of this video, I'll reveal 3 portfolio models you can copy today depending on whether you're building wealth in your 30s, balancing income in your 40s, or maximizing cash flow in your 50s. Let's get into it. Before we dive into the 5 ETFs, let me show you the exact system I use to find them. I call it the triple income filter, and it's designed to separate the winners from the wealth killers. It's built around 3 non-negotiables, missing even one, and you're risking years of underperformance. First, the growth engine. This looks at the 5-year compound annual growth rate, or CAGR, because yield means nothing if your principal is shrinking. We want ETFs that don't just pay, they build wealth. Second, cash flow consistency. That's not just the yield percentage, it's how stable and reliable that payout has been month to month. Has it been cut during downturns? This is where most high-yield ETFs fail. They flash big numbers, but the payments jump all over the place, or worse, disappear. Third, downside protection. How well does the ETF hold up during market drops? We look at drawdowns, volatility, and overall portfolio construction. Because if your income ETF falls apart every time the market dips, it's not income, it's just stress. These 3 filters are your insurance against regret. Stick to this framework and you'll avoid 90% of the noise out there. Now let's look at the first ETF that passed all 3 tests. ETF number 1 is JEPI, the fund that combines the safety of blue-chip stocks with high monthly income. It's called JEPI, the JP Morgan Equity Premium Income ETF, and I call it the blue-chip income machine. Here's why it stands out. JEPI invests in large-cap S and P 500 companies like Microsoft, Nvidia, Alphabet, and Meta. But what makes it unique is the options overlay strategy. JP Morgan's team writes covered calls on a portion of the portfolio to generate monthly cash flow. That's how they fund the dividend, not by relying solely on stock payouts, but by actively generating income through options premiums. JEPI currently yields around 8.35%, and over the past 5 years, it's delivered a 9.5% annualized return. That's extremely rare for an income ETF, especially one focused on monthly distributions. It also has a beta of just 0.57, meaning it's far less volatile than the S&P 500. Let's do the math. If you invest $10,000 in JEPI, you're looking at roughly $835 per year in dividends. If you reinvest those dividends over 10 years at a 9.5% growth rate, that $10,000 becomes around $24,782. That's income without sacrificing growth. The trade-off is that JEPI has a 0.35% expense ratio, which is higher than passive index funds, but you're paying for active management and downside protection. And keep in mind, those option premiums may be taxed as ordinary income, not qualified dividends. JEPI checks all 3 boxes of the triple income filter. Next up is an ETF that doesn't try to wow you with flashy yields, but quietly dominates where it matters most: total return. It's called SCHD, the Schwab US Dividend Equity ETF, and I call it the Dividend Aristocrat. Here's what makes SCHD different. It focuses on 100 high-quality dividend growth stocks from the Dow Jones US Dividend 100 Index. These are companies with 10-plus years of consistent payouts and strong fundamentals. Think energy giants, consumer staples, and healthcare leaders. Companies that not only pay dividends but raise them year after year. SCHD's yield sits around 3.8 to 3.9%, which might turn off income chasers at first glance. But here's where it flips the script. SCHD has delivered a 12.2% annualized return since inception, better than most high-yield ETFs, better than many growth funds, and it does this with an ultra-low expense ratio of just 0.06%. Let's break it down. A $10,000 investment in SCHD gives you roughly $390 per year in dividends. But if you reinvest those dividends over 20 years at a 12% growth rate, that $10,000 becomes around $96,463. That's the power of compounding with quality dividend growers. The trade-off is that SCHD's 2025 year-to-date performance has been softer, around 0.9% total return. But that's short-term noise. Over the long haul, this fund is built for investors with a DRIP mindset, dividend reinvestment plans, where every dollar received goes right back in to buy more shares. Now, stick around because ETF number 3 has a 19% return and pays a 14% yield. Sounds too good to be true? I'll show you how it actually works. Here's the newest ETF on this list, and it's already turning heads. It's called QQQI, the NEOS Nasdaq 100 High Income ETF, and I call it the Tech Growth Income Play. QQQI launched in January 2024, so it doesn't have decades of history behind it. But here's what it does have. Since its inception, it's delivered a 19.7% annualized return while paying a yield of 14%. Let me say that again. 19.7% growth with a 14% yield. It even won the award for Best New Active ETF at the 2025 ETF.com Awards. How does it do this? QQQI owns the Nasdaq 100, which means you're getting exposure to tech giants like Nvidia, Apple, Microsoft, and Meta. But instead of selling at the money-covered calls like most income ETFs, QQQI sells out of the money calls. That allows it to capture more upside while still generating serious monthly income. Here's the other advantage. A large portion of QQQI's distributions are classified as return of capital, which makes it more tax efficient than funds that pay ordinary income. That's a huge win for taxable accounts. Let's run the numbers. A $10,000 investment in QQQI generates around $1,300 to $1,400 per year in dividends. If you assume a 15% total return over 10 years, that $10,000 grows to roughly $40,455. The trade-off is that QQQI has a 0.68% expense ratio, which is on the higher end. And because it's so new, we don't have a full market cycle to evaluate how it performs during a prolonged downturn. But if you're in your 30s or 40s and want to reinvest dividends for long-term growth while still getting paid monthly, QQQI is worth a serious look. Now let's talk about a fund that doesn't pretend to be flashy because it's built for one job. Reliable growth with steady income. That's Devo, the Amplify CWP Enhanced Dividend Income ETF, and I call it the Stability Champion. Devo focuses on dividend aristocrats and blue chip companies, names like McDonald's, Johnson & Johnson and Home Depot. These are businesses with decades of dividend growth behind them and the financial muscle to keep paying through good markets and bad. But Devo doesn't stop there. It enhances income through a selective covered call strategy, writing options on a portion of its holdings. This results in a monthly distribution with a yield typically between 5 and 6%, while still leaving room for capital appreciation. Over the past 5 years, Devo has delivered a 44.42% total return, compared to SCHD's 32.63%. That's a 12% outperformance while paying more income. Let's do the math. A $10,000 investment in Devo generates around $550 per year in dividends. Over 10 years at an 8% growth rate, that $10,000 becomes roughly $21,589. Devo also scores excellent on downside protection. It has lower volatility than the S&P 500 and smaller drawdowns during rocky markets. The expense ratio is 0.56%, which is reasonable given the active management and options overlay. On the triple income filter, Devo ranks solid across the board, decent growth engine, consistent cash flow, and excellent durability. And before we get to ETF number 5, stick with me because I'm about to show you a side-by-side comparison of all 5 ETFs across yield, growth, fees, and tax treatment. You don't want to miss this. Last but not least, let's talk about a fund built for one thing: maximum monthly income. That's QYLD, the Global X Nasdaq 100 covered call ETF, and I call it the high yield cash machine. Here's how it works. QYLD owns the Nasdaq 100, just like any tech index fund. But every single month, it sells at-the-money covered calls on the entire index. The premiums collected from those calls are distributed to shareholders, creating a steady, high-yield income stream that rarely wavers. QYLD currently yields between 10.84 and 11.9%, and it's been paying monthly distributions for over 12 years. That income isn't tied to dividends from the companies themselves. It's generated through the call option strategy. So even when market prices dip, the income can remain strong. Let's run the numbers. A $10,000 investment in QYLD generates around $1,100 to $1,190 per year in dividends. Over 10 years, with a 6.8% annualized return, that $10,000 grows to roughly $19,348. Now here's the trade-off, and it's a big one. QYLD caps your upside potential. By selling at the money calls, you give up most of the gains when the market rallies hard. Over the past 5 years, QYLD's total return has been around 6.8%, which lags behind SCHD, JEPI, and even Devo. But here's the thing. QYLD isn't designed to beat the market. It's designed for investors who want predictable, front-loaded income from blue-chip tech companies without trying to time the market or chase volatile sectors. It's perfect for early retirees, conservative investors, or anyone building a stable cash flow system. On the triple income filter, QYLD nails cash flow consistency, scores solid on downside protection, but ranks lower on the growth engine. And like JEPI, its distributions are taxed as ordinary income, not qualified dividends. All right, let's stack these ETFs side by side and settle the score. Because on the surface, they all look solid, but this is where most investors mess up. They grab the ETF with the highest yield and ignore everything else. Here's the truth. A high yield isn't valuable if it's not backed by real growth, low costs, and downside protection. Let's walk through the data. First, CAGR, compound annual growth rate. SCHD and QQQI pull ahead here. SCHD has compounded over 12% annually, and QQQI has delivered 19.7% since launch. Meanwhile, QYLD's long-term growth is flat to negative in real terms. That's a hidden cost that compounds over time. Second, yield, what you actually take home monthly. QQQI and QYLD top the charts with double-digit yields. Devo sits in a sweet spot around 5 to 6%, and SCHD offers the lowest yield, closer to 3 to 4%, but makes up for it with growth. Third, expense ratio, what you're paying to own it. SCHD wins here at just 0.06%. JEPI, Devo, QYLD, and QQQI all fall between 0.35% and 0.68%. Higher fees can be worth it if they're driving better results, and that's where active management and options overlays come into play. Fourth, downside protection, how hard they fall when things go bad. Devo and JEPI shine here with lower volatility and smaller drawdowns. QYLD holds up well too because it's diversified across 100 tech stocks. QQQI is more volatile due to its tech concentration, but the returns have justified the ride. Fifth, Tax treatment, the silent killer. If you're holding these in a taxable account, the type of income matters. JEPI and QYLD trigger ordinary income, meaning higher taxes. SCHD and DIVO often pay qualified dividends, a win for long-term investors. QQC, Quai's return of capital structure, makes it the most tax-efficient of the group. So the takeaway is clear. Don't let yield blind you. Total return, stability, and tax impact matter just as much, if not more. 3 portfolios you can copy today. Now that we've broken down the ETFs, let's build real portfolios you can actually use. Whether you're in your 30s building wealth, in your 40s transitioning toward cash flow, or in your 50s planning the freedom phase, there's a setup for you. Portfolio number 1, the builder. Goal, reinvest every penny for maximum long-term growth. Allocation, 40% SCHD, 30% QQQI, 30% JEPI. Why does it work? Every distribution gets reinvested. Over 15 years, a $10,000 investment here could grow to over $42,000, assuming historical growth rates continue. Portfolio number 2, the balancer. Goal, balance between monthly income now and compounding later. Allocation, 30% SCHD, 25% JEPI, 25% DIVO, 20% QQQI. Why does it work? Half the portfolio pays a high monthly income. The other half keeps your future wealth growing. On a $10,000 investment, you'd see around $850 to $900 per year in income, with growth still working behind the scenes. Portfolio number 3, the income machine. Goal, maximize monthly income while capping volatility. Allocation, 40% QYLD, 30% QQQI, 30% DIVO. Why does it work? This mix delivers over $1,000 to $1,200 per year in monthly income on a $10,000 portfolio with reasonable downside protection. Great for early retirees or conservative investors who want dependable cash flow. These aren't theoretical models. They're battle-tested combos designed to match your goals, your risk tolerance, and your stage of life. If this video helped you, hit that like button, subscribe to the channel for more clear, hype-free investing content. And if you want to get rich in 2026 with a proven 5-step checklist, click the video on your screen. Hey, one last thing. I need to make this clear. I'm not a financial advisor, and this video isn't financial advice. I'm just sharing my research and perspective to help you learn and think critically about dividend investing. Every strategy comes with risks, and everyone's financial situation is different.